What is up, YouTube? My name is Adam Wilson and this is Broke Man Finance, a channel where we try to show you how to not be as broke as we once were. Today, I'm going to show you how to earn money passively and grow your portfolio on Robinhood through options. And I'm going to warn you, this gets very, very addictive and you're going to wish you had known this sooner and started a long time ago. I'm still kicking myself for not doing this sooner. Now, if you don't even know what options are or what the word even means, it's okay. This is episode 1 of the series, and we're going to start very slow and we're going to build on each episode from the last. Now, what you're going to get from this video is an easy and basic way to start earning money through options that is not complicated. What you're not going to get from this video is a bunch of terminology that you don't need yet, and you're not going to get a bunch of charts that is completely overwhelming and intimidated to a new options trader. There are literally textbooks with hundreds of different strategies. We're not worried about all that. We're going to start at a very, very basic level, and we're not going to throw a bunch of things at you. If there's one thing I hate whenever somebody's trying to teach me something new, it's when they try to throw all these words that they know I don't know what they mean yet and I don't understand, but it makes them feel good, it makes them feel smarter. That's not what we're doing. We're going to talk about this in a normal type conversation, an average person. I'm not going to try to talk over your head. Honestly, I'm still a beginner in all this stuff too. I haven't been doing this for years and years. So we're gonna bring it down a notch and make sure you can get your head wrapped around it. You've probably heard about people losing a lot of money trading options, and there is a risk there to do that, the same as there is a risk in just investing, period. Is there an elevated risk? Yes. But if you do it conservatively and you kind of heed my advice, you're going to be okay. Typically, the people that lost a lot of money got greedy, chasing premiums, and I'm going to explain what that is here in a few minutes, chasing that profit. And they just took big risks that were not needed. Now, a lot of times people's egos, they get a couple deals, they do pretty well, and they let their egos get in the way. And all of a sudden they believe they are smarter than they are. And all of a sudden they take a huge risk, they take a complete gamble, and it doesn't fall in their favor and they lose a lot of money. If you stick with this plan and stay conservative, you're going to mitigate a lot of risk and you're going to make money. I promise. Options takes a minute to get your head wrapped around. You may need to watch this video a couple times. I had to watch numerous videos numerous times because it didn't click for me automatically, especially whenever I'm selling something, but at the same time I'm having to put up collateral so it feels like I'm buying, and it was just very, very confusing to me. But I promise at the end of the video, all this is going to start making sense and you're going to be excited about trading options. Well, at least if you're a nerd like me, you will be. And for all you veteran traders out there, please, by all means, I would love to hear your comments, but save the comments of you should have said this or what about that. I get it, but this video necessarily isn't for you. This is for brand new people interested in earning money through options. And there's a good chance all those things that you're telling me, you should have said this, you should have said that, we're probably going to cover in a future video. We just don't want to overwhelm the viewer. And at the end of the video, I'm going to give you a few things to research on your own that'll continue to help you make better decisions with your money and learn the contracts, especially as we progress forward. It'll just make things a little bit easier. You'll start to pick things up a little bit quicker. First things first, if you have a Robinhood account and you don't see that option whenever you're looking at different stocks and companies, then you probably need to go to your settings page and turn options on. Robinhood will let you know if you qualify to trade options or you don't. Now, let's go. Okay, as you can see, I am on AT&T right now. And like I mentioned earlier, if you don't see this option right here for options, then you need to go to your account, go to settings, and turn options on, and Robinhood will figure out if you qualify or if you don't. So I'm on AT&T, a very popular stock. I'm going to go and hit trade options. Now, This is going to pull up a lot of stuff, and like I mentioned earlier, you may need to watch this twice because I'm going to try to cover everything, but I'm trying my best not to throw too much at you at one time. So there's going to be some things I don't go over, and I promise to go over those things later. But right now, I'm going to try to hit you with the high points. Okay, so this is what they call an options chain. If you hear that term, it's just a list. It's just a list of contracts. Each one of these things represents one contract. Now, you have to remember that each contract sells in increments of 100. So you have to multiply each of these things by 100, whether you're buying or you're selling. So this is going to be what you are. Are you a buyer or are you a seller? Today, we are a seller. We're not going to be selling calls. We're going to be selling puts. This particular options chain is going to be expiring on August 21st. And when I pull it up, you can see that it has weekly contracts. Now, each company stock is going to be different. So some may trade quarterly, some may trade weekly, some may trade monthly, some may not have options at all on Robinhood. A lot of that is going to be due to the volume in which the stock trades. You will notice on the right is what we call premium. That's what I'm after. I'm here to collect premiums and get out. As I mentioned earlier, everything is multiplied by 100, so these are going to be multiplied by 100 as well. So this is what it means. The closer they are to the share price, the higher these are, because there's more of a chance of getting assigned that contract and that contract getting exercised. So this 27 cents right here isn't 27 cents, it is $27. And as soon as I get this contract and it gets picked up, I earn $27 of credit. You can do whatever you want to with the money. You can reinvest it. You can go get food. It doesn't matter. That $27 is now mine, regardless of what happens. The seller, remember this, the seller of these is going to be collecting the premiums. That's the credit you're getting. The buyer is paying that for these contracts. Okay, so you're selling, and this is what it took me a while to get my head wrapped around, because I'm putting up collateral to earn the premium. So I'm selling a contract even though I'm putting up money for it. Okay, so let's talk about that. So the amount of money I have to put up is this. So let's stay with this one. Let's stay with this $29 strike price. That means that AT&T right now is trading for $30.01. It's the weekend, so the market's not open. Otherwise, you would see this right here continuing to fluctuate as you would these strike prices and percentages. All this stuff would always be moving around just about. But let's say you know what, you think that there's no way AT&T is going to go to $29 by August 21st. In fact, you think that AT&T is going to go up. You say, I want to buy or I want to sell this contract and collect that $5 premium. You got the money in there. There's the $3,100. I have the money. But so I'm going to have to front $2,900 or as collateral. And so I either have to have the funds available, or I'm going to have to do it naked, meaning I'm going to have to do it on margin. And your brokerage, whoever it is, like here, it would be Robinhood, obviously, would basically front me $2,900. They will determine my margin amount based off the value of my portfolio. It's not like you will have $500 in your portfolio and they're going to give you access to $25,000. That's not the way it's going to work. But if you have $25,000 in your portfolio, there's a good chance they're going to give you a pretty good percentage of that to play with. If you sell two contracts, like right here, if I wanted to buy two contracts of this, I would need that times 200. I would get $10 in premium instead of just that $5. The farther you get away from that share price, you will notice that premium going down because there's less risk of that contract getting assigned to you. So let's go all the way to $25. But the chances of AT&T going to $25 by August 21st is pretty dang low, right? I mean, look at the chances right here of profit. You look at that, times that by 100, that's a $1 contract. And in fact, there may not even be anybody that picks that up because the chances of that even getting exercised is pretty slim to none. Something pretty significant would have to happen for AT&T to drop $5. Okay, so but you understand kind of the concept of why. Now on the opposite end of that, if you look at this one, okay, $30. Right now it's at $30.01, so the chances of it hitting $30 is pretty significant. In fact, it would probably need to be closer to this for it to get exercised, because the buyer that's putting up the money for this contract is going to want to get that money back. So that's why when you see this 27 cents right here, take that away from that and you have this. That's the break-even price. So realistically, that strike price at 30, it can be exercised at 30, that's what you agree to, but the chances are it'll be closer to this when it actually gets exercised and you pick up 100 shares of AT&T. Now, there's a lot of stuff down here that we could talk about as far as implied volatility, the Greeks, Rho, Vega, Theta, Gamma, and Delta. And we're going to talk about all those because the Greeks are very important, as is the implied volatility. I don't want to throw too much out there yet. We're going to baby steps, and hopefully by the end you'll start to figure this out. And you will notice though that every contract you're going to see different numbers. Just going from 30 to 29.5, you'll see that difference in the delta, okay, and gamma, theta, all that stuff. But that's for another video in the future. Right now we're just trying to get the basic concepts down. So you may be thinking, well, $5 isn't that much for $2,900 collateral. That's true. And a lot of times these premiums are going to be based off the volatility of that stock. Now AT&T, for the most part, is pretty stable. They have some fluctuations daily, but for the most part, they don't have huge swings in the market. So let me show you what I mean. AT&T 3001, you see what these premium prices are for these strike prices. Let's type in Workhorse. So Workhorse is trading for about $15 a share, $15.24. All right, remember, we're going to go up here, sell a put. They also have, let's see, they have weekly options. But you can see here, this is where we were floating around with AT&T. You can look over here, $28, $45, $63. But the chances of those fluctuations in share cost are much greater in a speculative stock like Workhorse. It's much more volatile. And you can see that implied volatility right here is 92%, as opposed to the same place in the options chain with AT&T. I believe it was like 22%. But that's why you're going to earn more premium, and that's literally half the cost, less than half the cost of what the AT&T was, but it's 6 times the premium. But that's where people can get greedy, and that's where they can really mess up, especially on a stock like Workhorse or some of these more speculative stocks. Let's say they want to go and they want to earn, they start getting 4 or 5 contracts at this, and they're spending $6,000. They're fronting $6,000 to earn a big chunk, but then they get 600 shares of Workhorse. All of a sudden, Workhorse goes to $2.50, and now where are you at? That's where people get in trouble at. For me, I started out getting small contracts and earning smaller premiums, but that was just less volatile, so there was less risk. And I've slowly started to grow my portfolio over time. So let's look at AbbVie. AbbVie is one of my favorite stocks. So if I was going to sell a put, now we're going to need $9,500 worth of premium. It's not a really crazy volatile stock, but you can see the share price, or you can see the premium prices are going up. Let's look at Facebook. As your portfolio continues to grow, you can start looking at more options, like more expensive stocks, like a Facebook, $260 a share. So you go through here and you start seeing the potential, $390, $296, $217. All right, let's go to Apple. Before the split, $410, $287, $198, $588, almost $600. Let's say you're really moving and grooving. Let's go to Amazon. Let's say you have $400K in your account This is how the rich get richer. One contract, $4,400, $4,100, $3,600, $3,300, $2,800. Now, are you putting up a lot of money? Oh, hell yeah. But look at the return you're getting for not doing anything. If you don't have margin, you will need to go and sign up for Robinhood Gold. It's $5 a month, but you get access to margin. You get access to more in-depth reports about stocks. And also your first $1,000, your interest is covered by that $5 monthly subscription fee. And the margin also comes along with a 5% interest. But if you are playing with stocks that are in the S&P 500, which is what I recommend, and they're not very volatile, but they have a very good dividend, such as a Pfizer or an AbbVie, then that dividend can offset that, or AT&T can offset that interest that you have to pay. Here's some things to remember. You need to pick a stock that you know really well and that you do not mind having in your portfolio. If you're just chasing premiums and you don't know anything about the company, you're not well aware of the movement of that share price, and it's not a company that you really want to own, leave it alone. Don't mess with it. So if I bought this, whenever I was buying these contracts for the AT&T, it was fine. I was good with having AT&T. AT&T is not going anywhere. They have a great dividend, and if I do get assigned, okay, well, now I'm just going to sell a call against it, hopefully for a price higher than what I was assigned at, and I'm going to earn that premium plus that dividend and plus those capital gains. Easy peasy. My rule of thumb is this: I'm never going to sell a put against a stock that I am not comfortable owning 100 shares of. Like Nikola, I would never ever sell a put against Nikola because I am not comfortable. I don't want anything to do with Nikola. Trevor Milton, I would never ever sell a put against it. Are there some great premiums in there? Oh, I'm sure. Hell yeah, because it's so volatile right now. It's such a speculative stock. I'm sure there's such risk in it. I'm sure there's some great premiums, but again, is there a chance of something happening and that company going bankrupt tomorrow, or that share price going to $2? Absolutely. Once you do have, well, let's say that let's say this gets assigned to me. Let's say this contract gets assigned to me and I have a couple options. One I'm going to explain in the next video, and that's going to be how to buy that contract back and get out of that contract while keeping the difference. But that's what I'm going to show you in the next video, so don't worry about that right now. But what's going to happen is you'll hang on to that stock and it'll show up in your portfolio. You're going to hang on to that contract, rather. It'll be in your portfolio under options. And once it expires on that expiration date, it'll just disappear. It's easy money. It's very passive income because it's a cycle. It just goes round and round. Collect that premium. If it gets assigned, okay. Now you're going to sell a call against it, collect that premium, okay. You're going to collect that much more times 100 than what it was assigned at. So that's 150 more bucks that you would earn on the capital gains, plus the dividends that you could earn from AT&T, okay. Let's say it gets sold, fine. But if it gets out of the money, which is what we're hoping, then the contract just disappears and you keep collecting that $5 premium or that $11 or that $27, wherever it's at, whatever you're comfortable with doing. And if you're comfortable with doing some more risky stocks, then fine. And then if it's something that you know about, hey, no problem. Maybe your portfolio is big enough that you could just go ahead and start doing more expensive stocks. It's all good, but the main thing is, for me, is I'm going to collect that premium. So let's review. So what we did here today, we sold a put because we believe the share price is going to go up. So what we want to do is find a strike price we're comfortable with that we don't believe that the share price is going to get to by the expiration date. And by doing that, we earn $5 of credit, or 11 or 27, or wherever we feel comfortable. And there's pretty much an 89% chance it's not going to happen. The break-even price, remember, is a price that's got to get to so that buyer can earn back the money that they front, because we're sellers, so we're collecting premium. If we were buyers, we would be putting up that premium. If it gets assigned to us, fine, because we never sell puts against companies we are not comfortable with owning 100 shares of. If it does get assigned, no big deal, because then we go and we just start selling calls against it. We're going to earn some capital gains, we're going to earn some more premium, and we're going to earn some more dividends. And then as soon as that 100 shares gets assigned and that contract gets exercised, then we're back to selling puts. And so as our portfolio grows, we have more option opportunities with higher price shared companies like an Apple or Facebook or Tesla. If you really start getting up there, and with the stock splits coming, there's going to be a lot of money making opportunities with these options. So just something to think about. I hope this clears up a little bit. And there's so much more to this. And I'm going to show you in the next video, like I mentioned, that there are ways to buy your way out of the contract before you get here, so you can earn some of that, so you get to keep some of that credit and then roll on to the next contract. My thing is, I just keep collecting premiums on a weekly basis. It's such an easy and passive way to keep building my portfolio. Especially if you don't have thousands and thousands to invest every single week. You may need, if you're like me, you may need to squeeze every dollar of profit that you can, so you can take advantage of these bigger and bigger premium. Or if you want to buy 100 shares of something, you might as well sell a put near that strike price, let it get assigned, and collect that premium. That way, that premium drives that cost basis down even more on those 100 shares. As I mentioned, in the next video, we're going to be selling covered calls, the opposite of the puts, and we're going to be explaining all the benefits that come from that, because there are several. We're also going to be looking at buying out of the contract and being able to take those profits out quicker and moving on to the next contract. It's just a cycle. You sell a put, you collect a premium. If it gets assigned, who cares? It's no big deal, because that's a stock that you love anyway. Remember what we talked about. So then you're going to sell a call against it, collect that premium. Maybe you collect some dividends too, and hopefully you collect some capital gains in the process. I promised you some things to research until the next video. A couple things I think that is very important is we're going to be talking a lot about the Greeks. We're not there yet. We're still, like I said, we're building, but I would go ahead and start reading up on some delta and theta. Those are two really important Greeks, and just research what the Greeks are in general. Another thing you should look at is volatility crush. What is it? How does it affect those contract prices? It will make those muddy waters a little bit clearer. But until next time, I appreciate you guys watching the video. Remember to subscribe, hit that bell notification, and like the video. As always, stay safe and take care.